Hey, Kelly. Fidelity is out with its annual institutional investor survey today, showing increased exposure and bullishness on cryptocurrencies from that group. The firm surveyed more than 1,100 institutional investors, so think money managers, hedge funds, mutual funds. More than half of those guys say they now have some exposure to crypto. That average was higher in Asia at 71%. It was 56% in Europe. Meanwhile, the U.S. has the lowest exposure at 33%, but ownership is climbing across the board. It was up 6 percentage points in the U.S. 71% of institutional investors now say they plan to invest in digital assets in the future, and of that group, 90% say that they plan to make a move in the next 5 years and have at least some allocation to crypto. The number one barrier to entry still is price volatility. That was followed by lack of fundamentals to gauge value and concerns around market manipulation. Joining us now to talk about these results, Tom Jessup. He is the president of Fidelity Digital Assets. Tom, it's great to see you. Thanks so much for being here.
My pleasure, Kate. Nice to see you.
Let's start with Bitcoin this week. It's still below $30,000. What are you hearing from those institutional investors at these price levels? Are they still as interested as they were at $60,000 back in April?
Yeah, look, I'd say, consistent with broader market activity, there's been a decline in trading activity, but we've seen pretty consistent interest in terms of clients opening accounts and getting ready for an entry price that makes sense for them. I think what we've seen and others have seen in the institutional space is that they've tended to be, call it the steady pair of hands throughout this downdraft. And so, look, I think 30,000 was a psychological barrier for many, but we've drifted below that. Today, it doesn't seem to be an acceleration of selling pressure. I think the question is, when do people start coming in again? And as one of our customers said to me last week, he said, the problem with bear markets is that they tend to end with a whimper, not a bang. So it may be the case that prices get to a certain level, people feel constructive about the next leg up, and that we resume where we were back in towards the beginning of the year.
Got it. Let's home in on some of those barriers to entry. We talked about price volatility as number one. You say there was less concern about market infrastructure than years in the past. What changed there, and what still needs to happen to make some of these investors a little bit more comfortable?
Yeah, I think the first thing is just liquidity. I mean, there's a tremendous increase in the amount of available liquidity in the market over the past few years. You've got the entry of well-qualified service providers like Fidelity who focus on the needs of institutions. I think there's a general view that, really with the client's own education, that they are growing increasingly comfortable with the ability to deploy strategies with the same level of safety, soundness, and access to liquidity that they would in other asset classes. And obviously, we and others in the industry have a long way to go. But there's that initial indicia of a foundation there for institutional activity, which is very exciting as they start foraying into other corners of the asset class.
And Tom, we've talked a lot about Bitcoin as a hedge against inflation. This really seems like it could be the perfect environment for Bitcoin playing that role in the market based on some of the data we've gotten recently. It's really not. It seems to still be trading as sort of a high-tech growth play. Is the macro environment still a big reason that the investors you talk to are buying in? And if not, when will Bitcoin actually prove itself, if not in this environment?
Yeah, it's a great question. So I would say, there are two primary reasons why our clients are interested in the asset class. Certainly with Bitcoin, given its scarcity and sort of aspirational stored value properties, there is that linkage with the macro environment and the potential hedge against monetary or price inflation. Having said that, to your point, everything tends to correlate to one in times of market stress. So we have seen Bitcoin behave more like a risk asset, even overnight. And it may be several more months or even market cycles to know whether this thesis around Bitcoin being an inflation hedge is one that's durable. I think the other important thing to think about is, you're not just getting that in isolation. What you're also getting is effectively an investment in something that looks like, a front row seat to the next wave of tech innovation, right? So back in the late 80s, early 90s, we had PCs, which gave way to the internet, mobile technology. And I think there's an implicit acknowledgement in some of our survey results that investors are increasingly not only looking at this from a macro standpoint, but really starting to develop a thesis around how is this going to change financial services of the world. And that's not only borne out by our survey, but all the capital you've seen coming into the venture space, as well as the talent that's coming from traditional tech and finance into the blockchain world. And that's very exciting. And that this sort of the duality of some of these assets, including Bitcoin.
Shepard Smith here. Thanks for watching CNBC on YouTube.